A $9 billion energy deal. Let's talk to Ben Berkowitz, Reuters correspondent. All right, Ben, walk us through this. Freeport McMoRan Copper and Gold to acquire Plains Exploration and McMoRan Exploration for $9 billion.
It's a diversification play for Freeport McMoRan. They're big in copper, they're big in gold, they're running out of new prospects, running out of new places to find assets. So diversify into oil, into gas, places where they think there's more upside in the future.
Okay, they're paying a huge premium here, but you're saying in your story today that maybe these companies even want more?
Yeah, I mean, there's talk that, they're paying $50 a share equivalent for Plains. We're hearing from people who are saying $60 is more appropriate, even $70 a share is more appropriate. So there's some potential there for some disruption.
Okay, so for peers of Plains of these companies, are we going to be seeing more deals like this, or is this relatively unique?
This one's kind of unique because these three companies are really interrelated.
Okay.
It shows that there's a lot of interest in these oil and gas assets, but this particular deal has more of a sort of a family history behind it.
Because, and walk us through that just very quickly, McMoRan, we obviously see two of the same names there, coming from the same place, but even Plains has a stake in McMoRan Exploration,
Freeport
right?
McMoRan and McMoRan Exploration were both part of the same parent company, and now Plains owns about a third of McMoRan. So all these guys know each other. They've all been friends for 20 plus years. This is sort of a deal that some people saw as inevitable.
Okay, so great for them. They get to diversify. Freeport doesn't, as you're saying. Don't necessarily take this as an indicator that we'll be seeing more because they were all in cahoots, so to speak.
Exactly.
All friendly. Okay, Ben Berkowitz, thank you so much. I'm going to move now to Anthony Curry from Reuters Breaking Views. Anthony, news today out of Citigroup, probably the first big move. It is the first big move by the new CEO,
Absolutely,
Michael Corbat.
Yeah, he's come out and he said, look, we're going to cut 11,000 jobs, which sounds like a huge number, but don't forget this firm has almost 300,000 employees all around the world.
Right.
And a lot of the cuts are coming from retail. They're cutting in Turkey, Pakistan, and elsewhere, markets where they're just not really that big. But don't forget, this is a strategy really that Vikram Pandit, his predecessor who was ousted in October, was already following. He's been cutting costs, hiving off assets the bank doesn't want for the last 4 years or so. So there's nothing particularly unique about what he's doing. Well, maybe he's finding slightly better ways of allocating capital or resources, who knows. But it's not as if this is a really, really big deal compared to, say, what a UBS has done, saying we're going to exit fixed income trading completely.
Okay, right. So this is about 4% of the workforce. So if you're saying if Vikram Pandit was already doing this and Corbat's doing this now, what about Michael O'Neill behind the scenes, though? Is there something, because he's known for shrinking businesses that are not successful?
Oh, yeah. I mean, yes, exactly. But I think there was, to some extent, there was a personality issue with Pandit, but also I think he just wanted the bank to perform much better. And I think Pandit did a pretty good job, frankly, but it was still earning only sort of 7 or 8% return on equity at best each quarter, which is way below what it needs to break even on its cost of capital. So is O'Neill behind this? Well, I'm sure he likes the idea of more costs being cut, but I think, look, we've got this new CEO who knows this firm really well.
Yeah.
Now, it's not as if Corbat hasn't been there for more than, what's he been there, 20, 30 years now?
Right.
He knows Citi really well. He knows where the fat lies. He knows how to cut it, and that's what he's doing. So at the moment, at least, I say that this move, which isn't particularly revolutionary, is probably more Corbat than it is O'Neill.
All right. Wall Street likes it. Stock's up 5% today. Anthony, thank you so much.
Pleasure.
I'm going to move here to the hot spot on my own as walking over my cables here, and we're going to talk about mattresses, as we love to do on this show, because sweet dreams are made of this right here on Trading at Noon. I tried. Okay, Mattress Firm retailer, Mattress Firm, which is the retailer, their slogan, you may know it, sleep happy or your money back, and you may want your money back today if you're an investor, because they slashed their full year adjusted profit and sales expectations. They are saying that traffic slowed post-election. I don't know, the election was a nail biter. People couldn't sleep. They were buying lots of mattresses. Now whatever side you're on, you got to sleep with it either way. So they're not buying. Full year adjusted earnings between $1.49, $1.52 a share. That's down from the forecast of $1.67 to $1.73. Also affecting some stocks of some mattress manufacturers like Tempur-Pedic and Select Comfort, down 2% and 10% respectively. And Mattress Firm down 21% today. Let's move on to Apple, because IDC, International Data Corp, saying that the iPad and the iPad mini are losing market share to tablets run on Google's Android system, and that is driving down Apple's stock today. They were down 4.5% because the market share slipped from 53.8% to slipping from 56.3%. Microsoft's window also gaining, but relatively small there. So let's take a look at the broader markets, because we know that Apple has been weighing down the NASDAQ today. They've recovered some of those losses, and we've got some good numbers there. We've got the Dow up over 100 points there, and S&P up just a smidge as well. So perhaps the good news from Citi helping out there. And because we had seen that volume had been relatively muted due to fiscal cliff talks, Now, speaking of fiscal cliff, we're going to move on to Pandora. Why? Because the CEO of Pandora says that after their earnings call yesterday, that they lowered their fourth quarter guidance basically because the fiscal cliff is to blame, that advertisers are pulling back, that they're not going to get the advertising dollars that they see due to the fiscal cliff. Analysts are saying maybe this is a little bit of a fiscal cliff, dog ate my homework type of excuse, and they're saying that perhaps it's places like Spotify or even Sirius Satellite, or even the fact that Apple hasn't, rumored out there that they may be coming up with their online streaming radio service. But it is sending the shares down of Pandora today 17%. They say it's fiscal cliff. I don't know. You can listen to Jimmy Cliff on Pandora. That's it. That's what I got. That's what I got for today and today's show. All right. Follow us on Twitter at Reuters Insider and go to our YouTube channel, Reuters.com/Reuters TV. I'm Lisa Bernhard. This is Reuters.